Nilesh Surana, who's the head of equities at Mirae Asset Global Investments. Nilesh, thanks very much for speaking with us. Let me just directly talk about your Opportunities Fund, which is Mirae Opportunities Fund. It's a large cap fund essentially, and the focus is essentially having a larger weightage to large caps versus mid caps. Is that in line with the broad theme that you're playing in the market, where there is more interest coming into the large cap space?
See, Mirae Asset India Opportunities Fund is a large cap oriented fund. Yeah, you're right. We have about 70 to 80% investment in the large cap stocks. This is in sync with the benchmark, which is BSE 200 in this case. As a fund house, our investment thought process is essentially size agnostic, but in the current environment, we have preference to large cap companies, and also within mid caps, the preference is towards large quality mid caps. I think quality is very important. The size is not as meaningful. We have seen large caps underperforming in not so good sectors, and quality mid caps doing pretty well.
Right. The focus in the fund is on banks and financials. Is the preference still with private banks within that space?
Yeah, financials are a large part of benchmark indices, which is about 25% in BSE 200. We are at about 22% and the tilt is more towards private sector banks, and also we have the large private sector NBFC housing finance company. The sector is impacted by the headwinds in the economy, the slow growth, and most importantly on the what's happening on the NPA cycle. And it's tough to say if we are past the peak of the sort of NPA worsening. And in this context, we have seen that private sector banks are much more agile. They are more nimble-footed to sort of avoid the stress and also to handle the sort of delinquencies. So to our mind, the differential in valuation between the two buckets would continue, and we would continue to have we would continue to prefer private banks. More so with the recent fall, we would at these levels.
What is the view on energy stocks and upstream as well as downstream companies?
Energy is a sector where last 1 year significant reforms have taken place. I think if you have to single out one single reform which the government has taken is what has happened to the oil prices, the diesel prices, bulk diesel prices. And unfortunately, that enthusiasm is not fully appreciated for various reasons. One is large part of reform has been negated by the depreciation in rupee. There is a bit of confusion on the export parity, import parity issue, as well as in terms of the gas price hike, who would exactly gain how much, the beneficiary. That said, some of the upstream companies, the downstream companies, and even the upstream companies, many of they are at are historic lows. Downstream companies are at 10, 12 low in terms of the absolute market capitalization. So we have some weightage in the sector, and we would prefer downstream essentially because of the valuation. As I was mentioning, that they are at about 10, 12-year low, whereas in this period book would have increased by about 2.5 odd times, and now they are closer to attractive dividend yields.
Also, would want your perspective on the cyclicals on cement and infra names in this market. Are they an underweight?
Yeah, we have been underweight all throughout on infrastructure and cement. We have a large infrastructure company, the sector leader, and we have some exposure to a mid-cap cement company. Of course, cement has not done well, that position. Essentially, infrastructure business is been passing through tough times. And also, the character of the business is not very, we don't like much because the revenue line is lumpy, and more importantly, the free cash generation, free cash to EBITDA is not high, and that's reflected in the low return ratios. So we are underweight on infrastructure and also on cement.
Just wanted a quick perspective on autos, and do you think that the story there is over?
Auto, the OE piece in auto, the passenger vehicles, commercial vehicles, basically now is the second year of low growth. Commercial vehicles is degrowing significantly. We have some exposure there, but we have more exposure to certain auto ancillary companies where the return ratios are decent because of the, let's say, if it's a two-player market in batteries, that gives a bit of pricing power. And also in an environment where OE demand is weak, then some amount of replacement demand help the overall growth. So we are more positive on auto ancillaries and than in auto OE manufacturers.
All right, Nilesh, we leave it at that. Thanks very much for joining us and giving us that quick perspective.